believe that the market's worth hypothesis sees the market as random and unpredictable, which it is because it's new information that's affecting the prices. And amazingly, the randomness of the market actually indicates that prices quickly and accurately reflect information. 9/11, okay? The market's fail philosophy, the active money management, is that there's someone out there, a manager, an individual that knows what the price is going to be. That the price of a particular stock is wrong, that the market hasn't priced it correctly. And I'm not saying the market is perfect, but it's pretty accurate most of the time. The market's fail means that someone can find those mispricings, buy that stock, and wait for everybody else to realize that they missed the opportunity. And secondly, that person that finds that is going to tell you. Okay? Because if there were a person that could do that, they would be richer than Bill Gates. Because what they could do, and if you question it, look at how many brokers will take all of their money, sell everything, and put it into that one stock or that one company that they believe is going to be the best thing going. They won't do it. Okay? Why do mutual fund companies have 300 to 1,200 mutual funds in their portfolio? That will be up and down at different times. But how about this hypothesis? 50 large cap mutual funds. Okay? That means they got 50 managers that are trying to beat the large cap index, which is basically the S&P 500, right? Okay? Each manager's goal is to beat that index from this group of large companies, large stocks. Your problem is to know which manager is going to do it before the game starts. Now, you buy fund number 1 and you buy fund number 5. Has a name to it. The manager of number 5 doesn't like IBM. The manager of number 1 does. Number 1's buying, number 5 is selling, you own both. What's happened to your portfolio? Nothing, except your cost of going up, okay? So, you want to capture the market. You don't want 15 funds that own the same thing. When we do an analysis in our an MRI on the portfolio, we find that out of 7 funds, one company will be owned by 5, another company will be owned by 6, another company will be owned by 4. How diversified are you? Okay, so let's examine market beliefs between markets work and markets fail. What does it mean? We've covered that. What's the story? Anybody heard of Adam Smith? Back in 1876, I believe it was. He wrote a book that was called The Wealth of Nations. In The Wealth of Nations, he said that markets are the best predictor of prices. That the market itself will price goods and services better than any individual or any group of people, a committee. Have we seen that? What's happened? I mean, this answer has come about. We've seen the fall of the Russian Empire. What did Russia do? They set the prices. Okay? It wasn't the free market. Is there proof? Yes. Academia has plenty of proof to back up the market's work philosophy as well as the market's fail philosophy. 85% of the managers don't beat their benchmark. And those that do the following year, 85% of those will not beat the benchmark. We have the academic studies to prove it, which we go over in other seminars. So it's time to make a choice. Okay, there is a bar, kind of looks like this. Okay, markets work, markets fail. Time what is your market belief? Do you believe that there's someone out there that knows what the prices should be and can recognize or pick up that something's underpriced and that the market will go up or down, whichever way you're going, and you will benefit from that, okay? Okay.
I have a question.
Go ahead.
This sounds like you're like there's already an assumed price, and somebody's thinking, like you said, that it's the market's wrong about it, and they're hoping to cash out. Maybe they'll
Right.
try to make a profit. But what about like long term? There's a company you believe in or something like that, and you say, okay, I'm just gonna buy it and hold on to it for 15 years or something like that.
The problem that you have with that is the 3 rules of investing. Number one is to own equities. You'd be doing that by buying one company. The second thing is, how are you gonna rebalance and how are you gonna diversify? Okay? If you wanna diversify, just owning the S&P 500, and there's 500 companies in there, and you're buying round lots at $100 a company, you need about $2.5 million. Yeah, it works out to about $2.5 million. In order to get the diversification, buying round lots on the S&P 500 at 50 shares or 100 shares of each at $50 a share. Okay? If you buy one company, you are taking on a market risk for which you're not going to be rewarded. Okay? Let's say that you ever heard of a company called Bear Stearns? Okay? 75-year-old company that people were putting their grandmothers in because it was solid. It was great. Jim Cramer, you've heard of Jim Cramer, okay? On Mad Money. 6 weeks before it went down, he was recommending it as a buy. And even as it was going down, he was saying, oh yeah, don't give up on Bear Stearns. So if you held on to it, it went from about 75 to 0. Okay, go on. And when it disappeared in a week.